Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So the 4 positions for option, this is very, very important. So I hope you all get this. You have calls, which is the right to buy, and you have the puts, which is the right to sell. Very important. Remember, you want to think of it in terms of the base currency. Right to buy, right to sell, base currency. You have the right to buy the base currency, the right to sell the base currency. The seller has the obligation to sell, but not to guarantee, and that's the calls. And in the puts, they have the obligation to buy, but not to guarantee. So I like to teach options in one simple way. If you think the market, if you want limited risk, you have to be a buyer, because sellers have theoretically unlimited risk, although you can create spreads. That's a different topic for a different day. But that's possible. But buyers have limited risk. Sellers have unlimited risk. That's one thing that you need to think about. The buyer is going to pay a premium. The seller is going to receive that premium. So sellers are receiving income, and buyers are paying that premium. Question about hedging FX. We're not going to talk about that today, unfortunately, but I will go through what one contract is worth, and you could do the math on that. I've given classes on hedging, and I will talk about it briefly, and if you want to bring that up again at the end, we can go through a brief example. So thanks for the question. Rights and obligations. Option buyers receive rights. For these rights, they pay premiums. The buyers are also called holders. Sellers are going to receive obligations, and they're also called writers. Sellers have different risk reward than buyers. So essentially, if you think about it, buyers are going to be successful less often than sellers in general, because the sellers are receiving these premiums, but buyers have the ability to make an unlimited amount of money. Sellers don't. Sellers can only, the maximum that they can make is the premium that they receive. So you need to think in terms, options are about probability. That's all the prices are based on probability. So the options market might have certain probabilities, and you as a trader might have a different view. And that gives you an opportunity to trade here at the ISE. There's theoretically no inherent advantage of buying or selling options. The risk profiles create a balance for all market participants based on their own goals and their own risk tolerances. An opening transaction is the initial trade. So if you buy an option, you're opening, and you buy a call, you have rights. You buy a put, you have rights to sell, but you have rights. Or if you sell a call opening, you receive obligations. You sell a put, you receive obligations. If you want to close out your transaction, you do the reverse of your initial transaction. So if you bought an option and you want to close it, you sell it. If you sold an option initially, you want to close it, you buy it back. So there's always 2 parts to it. You don't have to actually do that second part. These options are cash settled at expiration, so you don't have to do that. But again, that is something that that's up to you. Buyers control exercise rights, so the decision to exercise is entirely up to the buyer's discretion. Why options? Well, options allow investors to implement their view of the marketplace with limited risk. So you can hedge. I've gotten questions on hedging. You can implement your forecast by buying options. You might even be a spread trader. Essentially, you're transferring risk from, let's say, one party to another by trading the options. So that's up to you and your goals and your own risk tolerances. So the premiums, let's go through premiums and how they work. If you buy an option, you're going to pay the premium to the seller. The seller doesn't get to keep the money initially. It just goes into their account. And that's a margin account essentially, but if the trade is successful, you get to keep the entire premium if you didn't close it out. But again, that will depend on the outcome subsequent to your initial trade. Premiums are paid, as I said, by the buyer to seller. Brokers, exchanges such as the IC, and the Options Clearing Corp help facilitate that process. The premiums are multiplied by 100. So if you see a $1 premium, what you're doing is really transferring $100. So that's 1 times 100. So every time you'll multiply those premiums that you see at your broker's site, or if you take a look at the ISE, remember you have to trade through a broker. You might go to FX Options to see the quotes, which you can definitely do. We have lots of tools at fxoptions.com. But you can't trade through the ISE. You have to trade through a broker. So you're going to need to open a brokerage account if you don't already have one. We have pricing models. In fact, at the site at FX Options, we have a pricing model, so you can work with it. You can use your own inputs, and you could determine your own values. Of course, you can trade within the constraints of the market, which is where the bids and where the offers are. But ultimately, as I said, supply, will, and demand are going to affect the price of the options, but you can use a pricing model to calculate what you think the prices could be or should be. And as I said, option prices are based on probabilities. The buyer can only lose what they paid for the option, but the buyer has to pay for that option the next day. The seller receives that money, although they can't spend it. The money will end up in a margin account until the trade is completed. Lots of different strike prices to trade. So you can buy an option, and you could buy one, let's say, the 100 strike. You could buy the 102, the 104, the 98. They're all going to offer different risk-reward relationships. So I might look at the Feb 100, and I might have the right to buy that exchange rate at 100 anytime until the third Friday in February. And there are different strike prices. There are in-the-money options, at-the-money, and out of the money. In-the-money options are the most expensive. So if, let's say if the U.S. dollar against the Canadian dollar, let's say, was trading at 104 and you're along the 100, well, that's in the money. The at-the-money might be the 104, and the out-of-the-money might be the 108 strike. So the cheapest options would be the out-of-the-money options. They offer more leverage. They also offer more risk in some ways because they have a lot of leverage built into them. You can buy a lot more options, and if it makes a big move, if the currency market makes a big move, you have an opportunity to make a lot more money. But if the market doesn't move at all, you would lose your entire investment. So they're in, at, and out-of-the-money options, and you could determine which one's best for you. The intrinsic value is the difference between where the currency, the pair value ends up, and at expiration versus the strike price. If the value, ISE value is greater than the strike, then you have some intrinsic value. For calls, for puts, it has to be less. Please remember, though, the intrinsic value can never be negative. Extrinsic value is everything else. So you might see an option that's out of the money. That means it doesn't have any intrinsic value. It has extrinsic value. Remember that when I talked about options initially, I mentioned that options are about probabilities. So you might see an option that's out of the money. Doesn't mean it's worth zero. There's a probability that the market might get to that or beyond that strike price, and therefore people are willing to pay for that right. And they're making some assessments on how far the pair value might move for a certain period of time. So you could look at that and make your own assessment if you think it's going to make a big enough move. The risk might be worth the reward or not. Please note, though, that at expiration, all intrinsic value is removed from the option. So at expiration, all options are going to be worth zero or their intrinsic value.
Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.